Okay, our last chapter 13 example will be exercise 8, and the main thing I want to show you here is looking at the capital accounts themselves versus the allocations we've done, as well as weighted averages. Hopefully you've done weighted averages in several classes. It's a key concept in accounting. We use it in a number of different areas, including here for average capital balance, just like we would do for weighted outstanding common stock in a corporation. So we're going to weight it based on the length of time that it was outstanding. So we'll start with Xavier, and Xavier started out with $24,000 invested. That investment was for 3 months before it changed, and then on April 1st, Xavier added $4,500, so the capital or the amount invested went up to $28,500 and remained that much for the rest of the year. So we see that he had a total $28,500 for those remaining 9 months. So you see we have the total. It's important to account for the 12 months. It's easy to skip a month or have your math off slightly, so that's an important check. And then we're going to multiply across to get the weighted dollars, and the total weighted dollars here then are 328.5 over the total months of 12, like we said. And our average then is taking the weighted dollars by the 12 months to get an average amount outstanding of 27,375. Now for Yates, you'll see that Yates' amount did not change throughout. So you could do ahead and do the calculations, but you're going to come up with the same 17,500 because nothing changed during the year for Yates. So then we need to go to Zale, and Zale had a starting balance of 13,000, which lasted for 6 months, and then on July 1st added 2,000 more, which lasted for another 2 months until September 1st, when another 15,000 was added. Total balance then was 30,000. So again, we want to make sure that we have 12 months, which we do, and we're going to then calculate the weighted dollars for each of those periods to get total weighted dollars. And if we calculate our total weighted dollars divided by the waiting period, average for Zale is 19,000. So then the interest that they each would be allocated is based on that weighted average times the 8% given in the problem. Xavier gets 2190 as an allocation for interest, Yates 1400, and Zale gets an allocation of 1520. That's part of their income. They also each equally then share the excess, which in this case, if we add up all of our interest, we see that we allocated a total of 5,110. Total income was 21,100, so there was a remainder of 15,990 that they're going to split equally, so they'll each get an additional 5,330. So their total income allocation is going to be based on their interest plus the 5,330. Now this section here is their actual capital accounts, just like a T account, and would be the equity section of this partnership. Now given in the problem, Xavier had a beginning balance of 24, Yates 17,500, and the 13,000, which all correspond to the amounts that we used up above for our weighting. We also know the investments because we used those for our weighting. We saw that Xavier added as well as Zale, but Yates did not add any amounts during the year. And then we look at their income. So for Xavier, it's going to be the 2190 plus the allocation that's equal to each of them for a total of 7520. For Yates, it'll be the 1,400 plus the amount that's equal for each of them, or 6,730. And for Zale, the interest plus the amount that's equal for each of them is 6,850. So that's their investments. Then we look to the withdrawals, which were also given. We take those out based on what was given there, and we can come up with an ending capital balance for each of the partners. So the ending capital balance for Xavier is 35,020, for Yates 23,230, and for Zale, $36,350, and total partnership equity then is $94,600. So hopefully this shows how these pieces fit together